So imagine a company that's carrying a market cap of like nearly $40 billion. They're pulling in quarterly revenue that completely dwarfs major established software players. I mean, we're talking double the revenue of a tech darling like Datadog.
Well, right, exactly.
And with that kind of hyper-growth profile, you'd think the stock chart should look like a vertical line, just going straight up and to the right. But instead, this company's stock just plummeted 11.4% in a single trading session.
Yeah, and zooming out slightly, it actually paints an even bleaker picture for anyone who bought the top. The stock is down over 53% from its recent peak.
Wow. 53%.
Yeah, it's massive. It is sudden wealth destruction on paper, especially for a company whose underlying business is, supposedly booming.
It's a total financial paradox, which is exactly why we're unpacking it today. So welcome to the deep dive. Today we are looking at CoreWeave.
Right, the pioneer in the emerging neocloud AI industry.
Exactly. And the mission for you today is to look past the immediate market panic screaming from the daily charts. We're going to dig into their underlying unit economics, the structural mechanics of this sell-off, and, well, the technical realities of their infrastructure.
Because we really need to figure out if this 53% haircut is a flashing red flag of a bursting bubble, or maybe a highly unique, asymmetric entry point into the whole AI infrastructure boom.
Right, because the human psychological response to a stock getting cut in half is to just run away.
Right.
You assume the market knows something you don't.
Oh, absolutely. But the structural data underneath this specific sell-off tells a significantly more complex story. It's really about capital expenditure, debt markets, and honestly, the physical limitations of building artificial intelligence.
So the overarching question to keep in mind as we go through this data is, are we witnessing the classic signs of a speculative tech bubble popping?
Or is this just the extraordinarily messy, capital-intensive birth of the next generation's cloud dominance?
Exactly. And to understand that massive divergence between CoreWeave's valuation and its current stock price, we really first have to strip away the buzzwords. We need to look at what they physically do.
Yeah, people throw around the term neocloud a lot. But the distinction between CoreWeave and a legacy cloud provider like an Amazon Web Services or Microsoft Azure, it's entirely architectural.
Because the legacy hyperscalers were built over the last, 15 years to be generalists, right?
Right, exactly. Their data centers are optimized for virtualization. They're slicing up servers to host millions of separate, relatively small tasks.
Like running an enterprise database or hosting a consumer app.
Yeah, or just serving web pages. But CoreWeave operates specialized, bare metal AI infrastructure. Training a large language model is fundamentally different from hosting a website.
It's a whole different beast.
Exactly. It requires tens of thousands of GPUs to work on a single massive problem simultaneously. And if those GPUs can't talk to each other with near zero latency, the entire cluster just stalls.
Which wastes millions of dollars in compute time, I imagine.
Yep.
Exactly. You can't have bottlenecks.
So I look at it like comparing a bespoke carbon fiber race car chassis to a commercial minivan. Amazon and Google are essentially trying to cram a high-performance NVIDIA engine into the back of their enterprise minivans.
That's a great way to put it. Whereas CoreWeave built the entire chassis from the ground up around that specific NVIDIA engine.
Right, they're using non-blocking InfiniBand networking topologies, right? Specifically designed so thousands of GPUs can exchange data without the bottlenecks you get on traditional Ethernet architectures.
Yeah, and that architectural advantage is precisely why NVIDIA backs them directly. NVIDIA wants its flagship GPUs running on infrastructure that showcases their maximum performance.
Not something bottlenecked by legacy virtualization layers.
Exactly. Now, NVIDIA also backs CoreWeave's closest competitor, a neocloud called Nebius. But CoreWeave commands that $40 billion valuation because their financial hygiene is significantly tighter.
Sure, Nebius is a strong player, but CoreWeave's balance sheet supports a much faster capacity expansion trajectory. Right, and that preferential relationship with NVIDIA is the entire foundation of their competitive moat. When there is a global shortage of the most advanced silicon on Earth, CoreWeave is basically placed at the front of the allocation line.
So even if a private equity firm decides tomorrow to throw $10 billion at a startup to build a rival AI cloud, it just doesn't matter. They simply cannot source the hardware fast enough to catch up.
Yeah, that supply chain moat is truly formidable, but that actually brings us directly to the $40 billion paradox.
Right, because having the best hardware and hypergrowth revenue is impressive, but we really have to look at the profitability spread here.
Exactly. Their gross margin is sitting at a highly impressive 69.38%. Yet their net margin is a staggering negative 25.57%.
Wait, negative 25%?
Yep, with a trailing 12-month earnings per share of negative $3.26.
The spread between those two numbers is basically the entire thesis of the company right now. Because a nearly 70% gross margin means the unit economics of renting out an AI cluster are spectacularly profitable.
Oh, incredibly profitable. When a developer signs a contract for 1,000 GPUs, CoreWeave is making a massive return on that specific compute cycle. At its core, the business model prints money.
So why the massive negative net margin then?
Well, the negative 25% net margin is actually a deliberate strategic choice by management. It's driven by this winner-take-most view of the AI infrastructure race.
Meaning they think showing a positive net income today is basically strategic failure if it means they lose future market share.
Exactly. To maintain their position, they're aggressively front-loading growth investments. Their capital expenditure plan for 2026 capacity requires spending approximately 5 times their trailing 12-month revenue.
Okay, let's pause on that, because spending 5 times your annual revenue is like a mathematical death wish for a normal corporate entity.
It really is.
You can have the best gross margins in the world, but bridging a gap that wide requires a terrifying amount of leverage. You can't just fund a multi-billion-dollar CapEx plan out of petty cash.
Right, and issuing that much equity would just dilute current shareholders into oblivion.
So how do they actually secure that kind of hyper-leveraged funding without completely imploding?
Well, they are exploiting a highly specific macroeconomic window. The broader capital markets are so desperate for exposure to the AI build-out that major institutions are essentially restructuring credit specifically for neoclouds.
Wait, really? Like who?
We recently saw Goldman Sachs and JP Morgan launch dedicated financial facilities allowing institutional investors to trade AI junk bonds.
AI junk bonds. That specific phrase is both fascinating and, honestly, a primary reason the retail market gets spooked.
Oh, for sure. But in this context, we aren't talking about distressed debt from a dying retailer. These are high-yield instruments from hyper-growth startups that simply lack the decade of stable, positive cash flow you need for a pristine investment-grade credit rating.
Okay, that makes sense. So the mechanics of these debt facilities are what allow CoreWeave to bypass traditional funding limitations.
Exactly. They are increasingly able to collateralize future compute contracts. If they secure a 3-year reservation from an AI developer for a new cluster, they can use that contracted future cash flow to back the high-yield debt required to physically build the data center today.
And the fact that the largest investment banks on Wall Street are spinning up dedicated trading desks just to handle this paper, I mean, that signals deep structural liquidity. The capital is there, just waiting to be deployed.
Right. But that staggering $5 billion plus CapEx tab is exactly what triggered the algorithms and retail traders to dump the stock on Tuesday.
Yeah, the market looked at the sheer volume of high-yield debt required to build these data centers and basically hit the panic button.
Definitely. Let's look at the actual price action because the anatomy of this specific sell-off is highly revealing. The stock sits at $71.88, which is hovering dangerously near the 52-week low of $63.80.
And we have to price in the volatility factor there, too. CoreWeave carries a beta of 2.94.
Yeah, which is high.
Very high. With a beta near 3, anyone holding this is going to feel every single macroeconomic tremor in the broader tech sector, magnified by a factor of 3.
Oh, absolutely. If the NASDAQ coughs, CoreWeave is going to the ICU.
Right. Any slight rotation away from semiconductors, any slightly hawkish tone from the Federal Reserve regarding interest rates, and this stock gets disproportionately punished by algorithmic trading models.
But there's a technical silver lining in Tuesday's 11.4% crash, and it's the volume profile. That drop occurred on a volume regime of just 0.85x compared to the 3-month average.
Okay, so a massive double-digit price drop on lower-than-average volume. That indicates a liquidity vacuum, right? Not an institutional stampede.
Precisely. If Vanguard or BlackRock were dumping their positions because they saw a fundamental flaw in the business, you would see massive volume spikes.
But we didn't. So this lower volume suggests selling exhaustion. It's retail capitulation and algorithmic stops triggering in a market where buyers simply step back for the day.
Yeah, the lack of high-conviction institutional selling is further supported by the absence of short squeeze symptoms. We aren't seeing massive, coordinated short-selling operations trying to force the price down through artificial technical pressure.
So the stock is mostly oscillating based on macroeconomic sector rotation and fundamental flows.
Exactly.
There is a piece of data that the bears point to aggressively, though. The insider activity shows a net sale of over 34 million shares in the past 90 days.
Right.
For an average retail investor, seeing early backers and insiders offload 34 million shares while the stock is down 53%, well, it looks like the people closest to the fire are running for the exits.
It definitely looks alarming on a screener, I'll give you that.
Yeah.
But the mechanics of venture capital dictate this behavior. CoreWeave is a relatively young public company.
So the early private investors, like the venture capital funds that backed them years ago, they operate on strict fund life cycles, typically around 10 years.
Exactly. Once a portfolio company goes public and the post-IPO lockup periods expire, the general partners of those VC funds have a fiduciary mandate to distribute those gains back to their limited partners.
Right, and these distributions are often mechanically scheduled months in advance through 10b5-1 trading plans. It's just a structural necessity of the private equity life cycle.
It's totally divorced from what the management team thinks the stock will be worth in 2 years. It's not a referendum on the 2026 CapEx plan. It's just a pension fund requiring its cash back.
Exactly that. So institutional interest, beyond those initial VC backers, remains heavily anchored by the strategic validation of the NVIDIA relationship.
Yeah, it really does.
Let's synthesize this tug-of-war for a second. We have a company doubling its peers in revenue, printing 69% gross margins, but taking on massive high-yield debt to fund a 5x revenue expansion, all while fitting at a 52-week low.
It's a lot to weigh.
It is. What does the landscape actually look like over the next 12 to 24 months for someone allocating capital here? Because the bear case seems entirely centered on credit risk and execution.
Well, the bear thesis is highly credible if the macroeconomic environment shifts. The most prominent risk is the sheer cost of servicing that massive debt load.
Right. If inflation ticks back up, or if the broader market loses its appetite for AI junk bonds, the yields on that debt will spike.
And CoreWeave's cost of capital could become suffocating before those 2026 data centers even come online. In a sustained risk-off environment where investors rotate out of hypergrowth tech and seek shelter in cash-flowing, dividend-paying stalwarts, a company carrying a negative 25% net margin is structurally vulnerable to further downside.
The bears are essentially arguing that CoreWeave is building the world's most advanced luxury hotel using high-interest credit cards, and if the credit markets freeze before they open the doors to guests, the whole project goes into foreclosure.
That's a very accurate analogy. But the advocates for CoreWeave argue that this existential risk is already fully priced into a stock that has literally been cut in half.
Because the bulls point to major macroeconomic tailwinds, validating the massive capex, right? Like Alphabet, recently raising its own internal AI capital expenditure forecasts.
Yeah, and that specific news immediately lifted CoreWeave's stock because it confirmed that the Tier 1 hyperscalers are still seeing massive forward demand. The underlying appetite for AI compute is simply not slowing down.
Analysts covering the sector are explicitly pounding the table on the stock at these levels too. But the immediate catalyst everyone will be watching is the upcoming earnings report.
Right, because the spot price of renting a GPU today is way less important than their forward guidance. The market needs to see if that $5 billion CapEx spend is actively translating into a contracted backlog of long-term revenue.
Meaning if they can demonstrate that clients are already signing multi-year leases for the capacity coming online in 2026, that negative net margin suddenly transforms into a coiled spring of immense operating leverage.
Exactly. And there is also an unconfirmed, highly speculative strategic rumor floating around the sector that would completely rewrite CoreWeave's long-term narrative.
Oh, really? What's the rumor?
Well, we know AMD recently partnered with Cerebras to build a disaggregated AI inference platform. The industry chatter suggests CoreWeave might be exploring this technology to diversify their infrastructure beyond NVIDIA.
Wow. Diversifying beyond NVIDIA, that's huge.
Yeah, potentially offering clients up to 5 times better efficiency and ultra-low latency for inference workloads.
Because disaggregated inference is a massive paradigm shift. Traditional AI models are often memory-bound. The processors are incredibly fast, but moving the data back and forth between the compute cores and the high-bandwidth memory takes too much time and energy.
Exactly. And Cerebras tackles this by using wafer-scale engines. They basically use an entire silicon wafer as a single giant chip, so the compute and the memory sit on the exact same piece of silicon.
That's wild. By disaggregating the architecture, they can pool compute and memory resources dynamically based on what the specific AI model needs at that exact millisecond. It radically reduces the latency bottlenecks that plague traditional GPU clusters.
Right, and if CoreWeave can integrate this architecture and offer enterprise clients a five-fold increase in efficiency, it drastically lowers the cost of running an AI model in production.
It also solves their single point of failure, because right now, their entire moat is their preferential access to NVIDIA.
Yeah,
Being the favorite child is great, until the parent decides to change the rules.
right.
If CoreWeave successfully integrates AMD and Cerebra's technology, they evolve from being a proxy for NVIDIA into a truly agnostic, premier AI infrastructure hub.
They'd basically become the underlying utility company, regardless of whose silicon is winning the benchmark tests that quarter.
So from a fundamental analysis standpoint, synthesizing the debt risk against the massive growth trajectory in these potential catalysts, the consensus analysis holds a bullish score of 7 out of 10.
Yeah, the conclusion drawn from the data is that this 53% sell-off presents a highly asymmetric entry point near the 52-week lows.
Asymmetric meaning the potential multi-year upside vastly outweighs the remaining downside risk, largely because the market has already aggressively priced in the fear surrounding the CapEx debt.
But the critical caveat for anyone analyzing this is the time horizon. This is not a technical swing trade for the next quarter. Realizing this value requires a minimum 1 to 2 year horizon.
Because the negative net margins will remain ugly while the construction happens. You have to wait for the physical concrete to be poured, the 2026 capacity to come online, and the operating leverage to finally bridge the profitability gap.
Right.
Which really brings us to the core reality of this deep dive. CoreWeave is executing a highly leveraged, utterly massive land grab for the future of artificial intelligence.
They are. And the retail market and the trading algorithms are looking at their current cash burn and punishing the stock today.
But when you analyze the structural mechanics of their 69% gross margin, their bare metal networking advantages, and their ability to tap deep institutional liquidity to fund their expansion, you see a company methodically building an insurmountable infrastructure moat.
They are actively choosing to endure the financial pain today in order to own the foundational layer of the internet tomorrow.
But the long-term success of that strategy hinges on an unknown variable that should really inform how you view this entire sector.
Exactly. We know CoreWeave is acquiring billions of dollars in physical hardware today to build this backbone. But as software algorithms inevitably become vastly more efficient, requiring significantly less raw computing power to achieve the exact same outputs.
Right. Will these massive data centers remain the most valuable real estate in the technology sector?
Or is there a structural risk that the underlying hardware rapidly commoditizes, sparking a race to the bottom in compute pricing before CoreWeave can fully pay off the billions in high-yield debt they used to build it?
That's the million-dollar question. Are we watching the birth of the next monopolistic utility, or just the most expensive, capital-intensive phase of a transient hardware cycle?
It's definitely something you have to weigh carefully.
The daily charts might be a mess of algorithmic panic, but the foundational unit economics operating underneath are impossible to ignore. Thanks for joining us on this deep dive. Keep questioning the consensus, watch the data, and we'll catch you next time.